Over the past few weeks, one of the most common reactions I've seen from investors, clients, and even casual observers of the market is the assumption that geopolitical tension automatically leads to fear, hesitation, and falling property demand. It is a very understandable reaction. When war, escalation, or regional conflict begins dominating global headlines, the instinctive conclusion for many people is that buyers will disappear, confidence will fall away, and major financial decisions will be postponed until calm returns. On a purely emotional level, that reaction makes perfect sense. Conflict creates uncertainty, and uncertainty makes people cautious. It affects headlines, conversations, and sentiment very quickly. Investors begin asking whether this is the wrong time to commit capital. Buyers start wondering whether they should delay major purchases. People who do not live in the region often assume that any instability nearby must inevitably damage the market itself. The logic appears straightforward. If the environment feels less certain, surely people must buy less property. But markets are rarely that simple. When you step back from the immediate emotional reaction and begin looking how capital has actually behaved across history during periods of geopolitical disruption, you often find that war does not simply create panic. In many cases, it also creates buyers. It changes the reason why people buy. It changes the profile of the buyer. It changes the urgency behind the decision. But it does not always remove the demand. Sometimes quite the opposite happens. Sometimes instability in one part of the world causes capital to move quickly into places perceived as more secure, more stable, or more strategically positioned. That is an important distinction because it changes the entire way you interpret what is happening in markets like the UAE. The first thing to understand that uncertainty often changes investor priorities rather than eliminating investor appetite altogether. In stable environments, people are generally more comfortable taking risk. They are more willing to pursue aggressive growth strategies, higher volatility opportunities, and shorter-term speculation. Capital may flow into equities, high-growth companies, emerging sectors, or more opportunistic asset classes because the broader backdrop feels more supportive of risk-taking. However, when geopolitical tension begins to rise, the mindset changes. The conversation becomes less about maximum upside and more about protection, preservation, and positioning. Investors begin asking where their capital is safest, where it's more resilient, where legal systems are more predictable, where infrastructure is strong, where the long-term growth still appears credible despite short-term uncertainty. In other words, they stop chasing excitement and start looking for solidity. That shift in mindset is one of the reasons property can become more attractive during periods of uncertainty rather than less. Real estate is not simply viewed as an investment vehicle. It is also viewed as a tangible asset, a strategic foothold, a store of value, and in many cases a lifestyle decision. For some buyers, it represents income. For others, it represents security. For others, it's part of a wider residency, wealth planning, or family strategy. When people feel that the wider world is becoming less predictable, the appeal of holding something real, something physical, and something anchored in a strong location can increase rather than decline. That is where the idea that war can create buyers begins to make more sense. Another major factor is relative safety. Investors do not make decisions in a vacuum. They are not just asking whether the world is uncertain, they are asking whether the uncertainty is lowest relative to other alternatives. That is a very different question. Capital does not simply vanish when tension rises. It moves, it compares, it relocates. It looks for places where the long-term case still feels strong and where the risk-adjusted environment appears to be better than elsewhere. This is why geopolitical stress often leads to repricing not just of assets, but of locations themselves. When investors reassess where to place money, they are comparing cities, countries, and systems. They are comparing tax environments, regulatory clarity, residency options, currency stability, lifestyle quality, access to business markets, and long-term strategic positioning. And in those comparative discussions, the UAE has increasingly become a serious contender. Dubai in particular has spent years positioning itself as a globally connected city that combines business appeal, lifestyle advantages, infrastructure, tax and safety efficiency in a way that very few places can match. That positioning becomes especially relevant during periods of global instability. Because when fear rises, people do not only ask where they should avoid, they ask where they should go. That applies to capital, but it also applies to people. War and geopolitical tension do not just affect investor psychology, they affect migration decisions. Families begin thinking more seriously about where they want to be based. Entrepreneurs reconsider where they want to grow their businesses. Professionals start looking for environments that feel more stable, more efficient, and more future-facing. Wealthy individuals and internationally mobile families often begin reviewing their exposure to particular regions and considering where they want to hold assets, residency, or operational bases. Property becomes central to all those decisions. And this is one of the most overlooked reasons why conflict can create property buyers. It is not only about fear-driven withdrawals from risk, it is also about the acceleration of relocation and diversification strategies. People who may have taken 2 years to decide often begin moving much more quickly once the world feels less predictable. They want optionality, they want a base, they want access, they want certainty where they can find it. And for many of them, that means buying rather than continuing to wait. In the UAE, that dynamic can be even more relevant because real estate is not simply a passive financial asset. It's often tied to the long-term financial planning. It's often tied to long-term lifestyle planning, business activities, and in certain cases, residency pathways. Buyers are not just assessing whether a unit will rise in value, they are asking whether this is a place that they can live, work, educate their children, hold capital, and create long-term optionality. That makes the value proposition much broader than simply yield calculation. There is also a more tactical reason why war or uncertainty can create buyers, and that is timing. When headlines become more negative, transaction speeds often slows. Some buyers step back, some sellers become more flexible, some developers begin introducing better incentive, more structured payment plans, or more negotiable terms in order to maintain momentum. In highly confident markets, buyers often have less leverage. Competition is strong, bidding becomes more aggressive, sellers can remain firm, developers do not need to stretch to secure interest. During more cautious periods, that balance can shift, and experienced investors understand this very well. They know the best opportunities are not always found where every headline is positive and every participant is full of confidence. Some of the strongest entry points appear when the market is still functioning. Demand is still present, but the sentiment is softened enough to create room for better decisions. That does not mean conflict is beneficial in any moral sense, and it certainly does not mean that risk should be romanticized. It simply means that market responds to psychology, and softer psychology can create better buying conditions for those who remain rational. That is one of the reasons that disciplined capital often behaves differently from emotional capital. Emotional capital reacts quickly. It sees fear and immediately steps away. Disciplined capital asks what has actually changed, whether the long-term thesis still holds, whether the current momentum is creating better pricing or stronger leverage, and whether this is a temporary interruption or a genuine structural shift. And that distinction matters enormously, because property markets are cyclical by nature. They do not move in straight lines. They expand when confidence is high, and they consolidate when the caution emerges. They accelerate again when clarity returns. And throughout those cycles, different types of buyers step in for different reasons. The investor who is too hesitant to buy at the very top may become active during a more uncertain phase. The family that had been renting may see an opportunity to negotiate better. The wealth preservation buyer may become more motivated precisely because the global backdrop feels unstable. Dubai has shown this pattern repeatedly across different cycles. There have been periods of expansion, correction, hesitation, recovery, and renewed momentum. There have been moments when global financial conditions changed sharply, when regional politics introduced uncertainty, and when broader economic sentiment weakened dramatically. Yet the city continued to attract capital because the long-term direction remained compelling. Infrastructure keeps developing, population keeps growing, new communities keep emerging, business activity continued evolving. In other words, the short-term noise has changed, but the long-term trajectory remains intact. That historical memory is important because experienced investors do not assess the present in isolation. They compare to previous episodes. They ask whether the current conditions reflect a temporary sentiment shock or whether they indicate a real breakdown in the market's structural appeal. More often than not, if the fundamentals remain strong, the conclusion is that the markets may slow, but is not necessarily weakening in any meaningful long-term sense. That is often where new buyers emerge. The buyers who believe in long-term fundamentals but have been waiting for more room to negotiate. The buyer who sees value in tangible assets during uncertain times. The buyer who wants exposure to a city that is still growing while many global markets feel over-regulated, overtaxed, or economically sluggish. The buyer who values security, lifestyle, infrastructure, and connectivity in equal measure. These are not irrational buyers. In many cases, they are some of the most considered participants in the market. Another key point is that institutional and sophisticated capital often behave very differently from retail sentiment. Retail participants are more likely to be influenced by dramatic headlines because their decisions are often more emotionally exposed and less insulated by strategy. Larger pools of capital, on the other hand, tend to operate on more longer horizons. Family offices, wealth managers, and institutional investors are genuinely focused on multi-year positioning. They study demographic trends, urban development, infrastructure pipelines, policy continuity, and economic diversification, rather than simply reacting to the latest news cycle. When those investors look at markets like Dubai, they see a city that has spent years building itself into a hub for trade, business, tourism, and international living. They see a leadership that has consistently planned for long-term growth. They see ongoing investment into transport, hospitality, technology, real estate, and quality of life. Those factors matter because they reinforce the idea that temporary uncertainty does not necessarily derail a larger growth story. Currency dynamics can also play a role in this process. During periods of instability, investors tend to become more aware of currency exposure and monetary risk. Assets linked to stable or stronger currency frameworks can become more attractive. The UAE dirham's link to the US dollar is therefore not an insignificant detail. For many international investors, holding assets in dollar-linked environments while also benefiting from the UAE's broader economic and lifestyle appeal can be a compelling proposition, particularly when uncertainty is rising elsewhere. Again, this does not mean conflict has no negative impact. Of course, it can slow down activity in certain segments. Of course, some buyers will delay. Of course, some participants will adopt a wait-and-see approach. But what matters is recognizing that these different responses sit alongside entirely different reactions from other participants. One group pauses, another group accelerates. One group focuses on fear, another focuses on opportunity. One group sees risk, another sees relative safety and strategic entry. That is why the market response is never one-dimensional. And this is exactly why saying that war simply creates panic is not an accurate reading of how real property markets function. Panic certainly exists, but so can urgency, relocation, diversification, and value-seeking behavior. The same event that caused one buyer to hesitate can cause another buyer to act. In markets like the UAE, that complexity becomes especially important because the investment case is supported by more than just sentiment. It is supported by infrastructure, policy, global connectivity, migration trends, business formation, lifestyle demand, and long-term strategic planning. Those forces do not disappear simply because headlines become more intense. If anything, in some cases they become more valuable. When the world feels more fragmented, stable hubs matter more. When capital feels less secure, credible jurisdictions matter more. When people want options, internationally connected cities matter more. And that is why, paradoxically, periods of geopolitical tension can increase the attractiveness of certain property markets rather than reduce it. For serious investors, the key is not to ask whether uncertainty exists. It obviously does. The key is to ask how uncertainty is reshaping behavior and whether that reshaping is creating openings. Is it causing better negotiation conditions? Is it speeding up relocation decisions? Is it pushing more capital into tangible assets? Is it making stable, internationally connected cities more valuable relative to alternatives? These are questions sophisticated buyers ask, because ultimately, property investment is rarely about predicting the next headline correctly. It's about understanding how people and capital respond over time. It's about recognizing that markets often behave in more complex ways than the public narratives suggest. And it is about maintaining that discipline to stay analytical when the broader environment becomes emotional. So when people say that war must inevitably reduce the property demand, I think that view is too simplistic. War can create fear, yes, but it can also create urgency. It can create relocation. It can create diversification. It can create demand for safety, structure, and tangible assets. It can create exact conditions in which certain buyers become more motivated, not less. That is not a contradiction. That is how capital behaves. If you understand that, then you begin to understand why periods of uncertainty are not always periods of paralysis. Sometimes they are moments where long-term investors step forward while short-term sentiment steps back. Sometimes they are the exact moments where disciplined buyers secure positions that look most intelligent in hindsight. That is why the smarter question is not simply whether conflict creates panic. The smarter question is what kind of buyer it creates, what kind of urgency it introduces, and what markets are best positioned to absorb that redirected demand. In the case of the UAE, and particularly Dubai, there is a strong argument that the market's combination of infrastructure, connectivity, economic ambition, and international appeal make it one of the places that can continue attracting serious interest even when the wider environment feels uncertain. So if you're currently looking at the market and asking whether war is purely a reason to stay away, I would suggest looking a little deeper. Ask what capital is doing, not what headlines are saying. Ask which buyers are leaving, but also which buyers are arriving. Ask whether hesitation in one segment is creating opportunity in another. And ask whether the current environment is not simply creating fear, but is also creating the next wave of strategic property demand. If you would like to discuss how this type of market psychology can influence buying opportunities, timing, or negotiation in the UAE property market, feel free to reach out.